As the White House spirals into panic, Wall Street crumbles, and the world turns its back on the dollar. What is really happening? In just a single day of chaos, over 700 points vanished from the Dow Jones. Longtime allies like Canada declared their break from the U.S., and Trump poured gasoline on the fire with threats of 200% tariffs that ignited a fierce European retaliation. As investors flee and the nation once seen as the global financial center teeters on the brink of abandonment, Trump's re-election has unleashed not just turmoil at home, but a geopolitical earthquake worldwide. And now the biggest question remains: can America still save itself, or has it entered an irreversible era of decline? A storm of collapse, America's day of financial chaos, and the global shockwave that followed. On what will be remembered as one of the most catastrophic days in modern American financial history, the markets cratered at breathtaking speed, dragging with them the last remnants of confidence in the White House's ability to steer the country out of economic peril. More than 700 points were wiped off the Dow Jones Industrial Average in a single day, plunging the U.S. deeper into uncertainty. What was intended to be a moment of reassurance, a press conference meant to project calm and control, instead unfolded as a public unraveling of the administration, broadcast live to a horrified global audience. The trigger? A combination of dreadful economic data and political missteps that, when combined, proved explosive. Fresh financial reports released that morning painted a bleak picture. Inflation remained stubbornly high, consumer sentiment had soured dramatically, and leading economic indicators were flashing red across the board. The Dow's plunge of over 720 points was just the beginning. The S&P 500 shed more than 113 points, while the tech-heavy Nasdaq nosedived nearly 500 points, its sharpest decline in many months. Yet as devastating as these numbers were, the real earthquake lay not in the figures but in what followed. On that turbulent day, Fox News, and traditionally one of the most steadfast allies of the administration, delivered a political shockwave. Their latest poll exposed a sharp erosion of public trust. 56% of Americans disapproved of how the president and his cabinet were managing the economy, while only 43% maintained faith in their leadership. This fracture was far more than just a statistical dip. It symbolized a breaking point. Beyond U.S. borders, respected international economic forums like the World Economic Forum and the OECD had already sounded alarms, warning that rising protectionism was not only inflaming domestic discontent, but also fraying global trade ties. Meanwhile, a Bloomberg analysis suggested that U.S. trade credibility was eroding faster than at any point since the early 1970s, when Nixon ended the gold standard. The erosion of public support, as captured by the Fox poll, perfectly mirrored the growing frustration among global trading partners, from Europe's industrial hubs to Asian export economies. For an administration that once claimed to be the champion of economic nationalism, this moment exposed an uncomfortable truth. Not only was the world losing faith in America's leadership, but so too were its own citizens. In a bid to regain control of a rapidly deteriorating situation, the White House hastily staged an outdoor press conference, hoping that a public display of leadership would ease the growing anxiety in both domestic and international markets. The intention was unmistakable: project confidence, assert control, and send a clear message that the administration was steering the country through turbulent waters. However, instead of assuaging fears, the event magnified them. Press Secretary Caroline Leavitt, facing relentless questions about the administration's strategy to arrest the economic freefall, defaulted to a defensive posture. Rather than outlining concrete measures, such as stimulus packages, renegotiated trade terms, or targeted relief for critical industries, she fell back on combative talking points. Her rhetoric, laced with condescension, brushed aside constitutional concerns and global apprehension alike, fueling the perception of an administration adrift. International observers were quick to react. Reports from the Financial Times and Nikkei Asia noted that global investors had been watching the press conference closely, hoping for signs of fiscal prudence and global cooperation. Instead, they witnessed a government appearing isolated and unprepared. Analysts at the Peterson Institute for International Economics even remarked that the U.S. seemed more focused on domestic political theater than addressing the alarming fractures in international trade relations. Rather than stabilizing markets, the event only deepened the global sense of unease. Then came the moment that turned confusion into full-scale panic. The president himself, visibly rattled but unwilling to concede weakness, floated the controversial idea of a third term. Though likely a provocation or an attempt to rally his base, the mere suggestion of defying constitutional limits sent shockwaves through the public consciousness. Instead of tamping down speculation, this offhand remark ignited a national debate. If this administration was willing to entertain violating the Constitution, what other boundaries might it cross? The implication was chilling. Americans began to question not just the administration's economic strategy, but its respect for the rule of law itself. What had started as a market crisis was quickly morphing into a constitutional one. Journalists pressed harder, sensing vulnerability, yet the White House offered no real answers. Rather than announcing concrete measures, such as interest rate adjustments, targeted relief for small businesses, or temporary tax holidays, officials stuck to vague platitudes and empty reassurances. The public, and especially the markets, noticed the void. Behind the scenes, the situation was deteriorating just as rapidly. Astoundingly, $390 billion in U.S. government bonds was liquidated in a matter of hours. But this wasn't a domestic protest. It was a coordinated global retreat. From Beijing to Brussels, from Oslo to Tokyo, governments and investors alike were rushing to decouple from U.S. assets, fearing that America was steering itself straight into a fiscal storm. The reasons went far deeper than the day's headlines. Trump's re-election had reignited deep anxieties among America's allies and economic partners. His hallmark America First doctrine, characterized by steep tariffs, aggressive sanctions, and a confrontational diplomatic style, was back in full force. Global leaders worried that the return of such policies could escalate trade wars, destabilize international markets, and undermine the predictability of global commerce. With U.S. interest rates climbing, the traditional allure of U.S. bonds diminished sharply. The yields on these securities no longer compensated for the growing risks associated with America's increasingly erratic political and economic behavior. Compounding matters was the backdrop of geopolitical turbulence. The lingering fallout from the Russia-Ukraine conflict, mounting U.S.-China tensions, and the global inflationary spiral that had already strained economies worldwide. Countries began recalibrating their financial strategies with remarkable speed. They were no longer content to rely on the U.S. dollar as the bedrock of their reserves. Instead, many turned to alternative assets such as gold, the euro, or even emerging digital currencies, seeking refuge from America's fiscal unpredictability. The scale of the exodus was staggering. In the last quarter of 2024 alone, Brazil pulled $55.9 billion from U.S. securities. Ireland reduced its holdings by $42 billion. The Cayman Islands and Canada followed suit, withdrawing $41.2 billion and $37 billion, respectively. India and Norway each slashed their stakes by nearly $35 billion. Even stalwart allies like Japan and China pared back their positions by $7.8 billion. This wasn't mere diversification, it was a clear vote of no confidence in America's future direction. The message was unmistakable. Washington could no longer take for granted its privileged role as the world's safe haven. The domino effect, retaliation and trade war eruptions. As if the domestic chaos weren't enough, the Trump administration chose this volatile moment to escalate tensions on the global stage. On April 2, 2025, a sweeping package of new tariffs, described by the White House as reciprocal measures, came into force, targeting nations that the administration claimed were exploiting U.S. markets with unbalanced trade practices. Rather than soothing anxieties, this aggressive move ignited a firestorm of retaliations worldwide, confirming the worst fears of economists who had long warned that trade wars are easier to start than to contain. The European Union moved with remarkable speed, unveiling counter-tariffs on iconic American exports such as Harley-Davidson motorcycles, Tennessee whiskey, and Levi's jeans, unmistakable symbols of American culture and commerce. EU Trade Commissioner Valdis Dombrovskis remarked that Europe would not be held hostage by unilateral American tariffs, framing the U.S. move as a clear violation of World Trade Organization (WTO) norms. German business leaders in particular expressed alarm, fearing disruptions to transatlantic supply chains that support thousands of jobs in sectors from automotive to aerospace. China, already locked in a simmering rivalry with Washington, seized the moment to reinforce its own economic defense. Tariffs on U.S. soybeans, pork, and corn were increased significantly, further tightening the pressure on American farmers. According to an analysis by the China Chamber of Commerce for import and export of foodstuffs, the move was part of a broader strategy to diversify agricultural imports, with new trade routes being developed with Brazil, Argentina, and even Russia. Chinese state media emphasized that the days of over-reliance on U.S. commodities were decisively over. Meanwhile, Canada, long regarded as America's most dependable economic partner, surprised many by taking an uncharacteristically bold stance. Ottawa initiated public consultations to fast-track a $15 billion suite of retaliatory tariffs aimed squarely at U.S. goods. Canadian Trade Minister Mary Ng declared that Canada will not be bullied at the negotiating table, a sentiment echoed widely across Canadian media outlets. Behind the scenes, Canadian policymakers accelerated trade talks with the EU and Asia-Pacific partners, working to cushion their economy against American volatility. Beyond these headline responses, ripples spread across global supply chains. Nations such as South Korea and Australia began reassessing their trade exposure to the U.S., quietly shifting procurement strategies toward regional partners. A report by the World Trade Organization noted that these cascading retaliations had already begun to strain the global flow of essential goods, from semiconductors to agricultural machinery. Economists at the IMF warned that this spiral could shave as much as 1.7% off global GDP if unresolved by year's end. In effect, the Trump administration's tariff barrage triggered a chain reaction, one that rapidly exposed the vulnerabilities of an interconnected world economy. What began as a unilateral assertion of economic strength morphed into a dangerous cycle of escalation, ensnaring allies and rivals alike in a trade conflict with no clear off-ramp. The fallout. American industries under siege. The repercussions of the escalating trade wars rippled through the American economy with brutal speed. Nowhere was this more evident than in the agricultural heartland, where farmers, once buoyed by consistent demand from overseas markets, suddenly found themselves teetering on the brink of collapse. China's retaliatory tariffs in particular proved devastating. Once the largest buyer of U.S. soybeans, China had already been diversifying its imports toward Brazil and Argentina in anticipation of ongoing hostilities. But now Beijing formalized those shifts, locking in new long-term contracts that squeezed American growers out of a market they had dominated for decades. According to data from the U.S. Department of Agriculture, soybean exports to China plummeted by over 70%, with some farming cooperatives in the Midwest reporting near-total losses for the season. Corn and pork producers faced similar predicaments. China, seeking to protect its food security, aggressively ramped up imports from Eastern Europe and Southeast Asia, while also investing in domestic production to further insulate itself from future trade tensions. Meanwhile, Europe, typically a reliable, high-value destination for American agricultural goods, turned inward, bolstering subsidies for its own farmers and expanding imports from neighboring countries. Reports from Agence Europe and Euractiv noted that French and German policymakers saw the crisis as an opportunity to reduce their dependency on U.S. imports and strengthen intra-European supply chains. The pain extended far beyond the farms. The American auto industry, a pillar of manufacturing in key political battleground states like Michigan, Ohio, and Indiana, found itself squarely in the crosshairs of retaliatory tariffs and rising costs. The Global Auto Report by PwC highlighted how increased tariffs on imported parts, particularly electronics and specialized components sourced from Asia and Europe, drove production costs up sharply. Manufacturers were left with a bitter choice: absorb the losses or pass them on to consumers already squeezed by inflation. As sticker prices soared by an estimated $1,000 to $3,000 per vehicle, consumer demand predictably softened. Assembly lines at major plants began to idle, and the dreaded wave of layoffs followed. In Michigan alone, estimates from the Center for Automotive Research projected job losses could exceed 25,000 if trade tensions persisted into the next quarter. The auto supply chain, deeply integrated and globalized over decades, simply could not adjust overnight to the new realities of protectionism. What became increasingly clear was that America's role as the linchpin of global finance and trade was no longer secure. International competitors, sensing vulnerability, accelerated their own industrial strategies. South Korea and Vietnam, for example, intensified efforts to capture market share in sectors like automotive electronics and agricultural exports. Meanwhile, Europe and China doubled down on regional trade pacts, aiming to shield their economies from U.S. volatility. Financial analysts from HSBC and the World Bank echoed this grim assessment, warning that the United States risked becoming isolated in a rapidly multipolarizing world economy. The illusion of economic invincibility was crumbling, and fast. Thus, the pressing question emerged: would the White House, entrenched in its protectionist crusade, stubbornly continue down this perilous path? Or would this crisis mark a turning point, a moment when the global balance of power would decisively shift away from American dominance, heralding a new era of multipolar economic leadership? Canada's defiance and the rise of a new alliance. While Washington flailed, Canada seized the moment. Far from retreating, Ottawa accelerated its diversification away from U.S. dependency. Trade with the European Union skyrocketed by over 50% in just 6 years, while relations with the U.S. reached their lowest point in decades. In a powerful symbol of this pivot, Canadian Prime Minister Mark Carney snubbed Washington on his inaugural overseas trip, heading instead to Europe, a move laden with diplomatic symbolism. The fracture between the U.S. and Canada, once the steadiest of alliances, had become a full-fledged trade war. Beginning February 1st, 2025, the U.S. imposed a 25% tariff on most Canadian imports. Then, just weeks later, Washington doubled down, slapping a punishing 50% tariff on Canadian steel and aluminum. The shockwaves reverberated globally, but Ottawa wasn't about to capitulate. On March 12, 2025, Canada retaliated decisively, imposing its own 25% tariffs on $21 billion worth of U.S. goods. But this was more than a symbolic gesture. Canada's counterpunch targeted key American industries, from metals to high-tech products to everyday consumer goods, inflicting real pain on U.S. exporters. Canada's strategy extended beyond economics. The nation deepened military cooperation with Europe, joining the EU's PESCO defense initiative and taking a leadership role within NATO deployments in Latvia. In intelligence sharing and cybersecurity, Canada expanded its alliances with European partners, positioning itself not just as an economic peer, but as a geopolitical equal. Astonishingly, Canadian public opinion mirrored this shift. By early 2025, nearly 68% of Canadians viewed the European Union more favorably than the United States, and nearly half entertained the once unthinkable notion of pursuing EU membership. For Washington, the alarms were deafening. Yet, attempts to lure Canada back through economic coercion, including threats of auto tariffs and pressure campaigns against U.S. corporations operating north of the border, fell flat. The writing was on the wall. Canada was no longer content to play second fiddle to its southern neighbor. The EU wine war, another front in the global trade clash. As tensions between Washington and Brussels flared, a new and symbolic battlefield emerged: the transatlantic wine trade. When President Trump threatened to impose staggering 200% tariffs on European wines and spirits, with French Champagne, Italian Prosecco, and Spanish Reds in the crosshairs, it wasn't just an economic move. It was a direct assault on one of Europe's most prized cultural and commercial sectors. For the European Union, whose wine and spirits exports to the U.S. had reached over $13 billion annually, the shock was immediate and profound. Wine in Europe is not merely a commodity. It is heritage, identity, and a source of immense economic pride. French President Emmanuel Macron called the tariffs an unacceptable attack on Europe's cultural and agricultural treasures, while Italy's Minister of Agriculture described them as economic warfare disguised as policy. French wine councils, CIVC and CNIV, warned of disastrous impacts, estimating that champagne exports to the U.S. could fall by as much as 60% if the tariffs were enacted. The EU responded swiftly and decisively. European Trade Commissioner Valdis Dombrovskis declared that the bloc was prepared to unleash counter-tariffs on emblematic U.S. products: bourbon from Kentucky, Californian almonds, and iconic Harley-Davidson motorcycles. European policymakers, once hesitant about escalating trade confrontations, unified quickly in defense of their flagship industries. The European Parliament even fast-tracked emergency subsidies for affected wine growers, while also seeking new markets in Asia and the Middle East to cushion the blow. Yet within this clash of titans lay a hidden silver lining for American vintners. With European wines facing steep price hikes, producers from California's Napa Valley and Sonoma County, as well as emerging vineyards in Texas Hill Country and Oregon's Willamette Valley, spotted a rare opportunity. According to data from the U.S. Wine Institute, domestic wineries could potentially increase their market share by 15% to 20% within the U.S. market alone, as consumers priced out of European options sought local alternatives. Moreover, international doors were opening as well. Asian importers, particularly in China and South Korea, wary of the volatility surrounding European exports, began turning to American suppliers. Japan, under its expanded free trade agreement with the U.S., signaled intentions to lower tariffs on U.S. wines, paving the way for a surge in American vintages across high-end Tokyo restaurants and luxury hotel chains in Osaka. However, this potential boon for U.S. producers did not offset the broader fallout. Behind the headlines, trade experts from the WTO and the OECD cautioned that the dispute was deepening fractures in global supply chains. "What we're witnessing is a fragmentation of trust in the multilateral trade system," remarked Pascal Lamy, former Director General of the WTO. Long-term damage to U.S.-EU relations could extend far beyond wine and spirits, risking retaliation across sectors like aviation, pharmaceuticals, and tech. Furthermore, European vintners were not giving up without a fight. Leveraging centuries-old branding and deep consumer loyalty, they launched aggressive marketing campaigns to defend their foothold in premium markets. France's Drink European Support Tradition initiative and Italy's Viva Vino. campaign both aim to rally global consumers to support European craftsmanship, despite price increases. In the end, while American winemakers stood poised to capture new opportunities, the broader implications of this tariff skirmish served as a stark reminder. Trade wars, even when they open unexpected doors for some, leave lasting scars on the global economy. Beneath the allure of short-term gains lay a deeper erosion of trust, as once reliable trade partners drifted further apart in an increasingly unpredictable global landscape. The road ahead: collapse or reinvention. As the turbulence of market crashes, retaliatory tariffs, and diplomatic standoffs begins to settle, at least momentarily, Mondo, the question hanging over Washington is no longer theoretical. It is existential. Will the United States, once the uncontested architect of global trade, continue its drift into protectionist isolation? Or will this crisis become a pivotal moment of reinvention, forcing a strategic reset that can restore confidence at home and re-engage disillusioned global partners? Voices from across the international stage are weighing in. A report from the Brookings Institution warns that if current policies persist, the U.S. risks marginalization in fast-evolving regional trade blocs like the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, and the Regional Comprehensive Economic Partnership, RCEP. Meanwhile, the European Union is accelerating its pursuit of autonomous trade corridors, notably deepening ties with African economies in South America through new free trade agreements, diminishing reliance on U.S. markets. Some American business leaders, particularly in tech and agriculture, are pressing the White House for a course correction. The U.S. Chamber of Commerce has openly called for re-engaging in multilateral negotiations to rebuild lost trust. Even allies like Japan and Australia are cautiously encouraging Washington to embrace a more collaborative trade posture, warning that a multipolar world is already emerging, with or without U.S. leadership. The world watches cautiously but resolutely, knowing that America's next moves will echo far beyond its borders. The United States, once the anchor of global trade, now stands at a crossroads between collapse and reinvention. What began as a financial tremor has erupted into a worldwide storm of retaliation, isolation, and lost trust. Allies are turning away, markets are fragmenting, and America's own industries are bleeding under the weight of escalating tariffs. Yet even in this chaos, a narrow path forward remains, one that demands hard choices and global cooperation, not unilateral bravado. But the question that lingers is this: can the U.S. pull itself back from the brink and reclaim its role as a leader in global trade? Or has the era of American dominance already slipped away for good? We'd love to hear your thoughts. Where do you think the world is headed next? Drop your opinions in the comments below and let's discuss.